Ladies and gentlemen, good afternoon wherever you are across this world today. My name is Patrick L. Young. It is a pleasure to be here with you virtually at this Arab Federation of Exchanges Summit this year to discuss the fascinating topic of central counterparty clearing and clearing houses. Of course, a very exciting year for the derivatives landscape already, and we're only at the end of Q1 of 2021, thanks to the launch in the last couple of days of the IFAD, the ICE Futures Abu Dhabi, bringing us Murban crude as a potential new benchmark. And indeed, slightly before that, and indeed something we'll get to with one of our panelists in a moment, the whole topic of the building of the Tadawul Central Counterparty Clearinghouse. A joy to see a new clearinghouse in the parish of exchanges during the course of the last 6 months. Our guests today are an exciting panel of experts in the field. In alphabetical order, we have Andrew Dodsworth, who is the Operations and Risk Director at one of the leading clearinghouses in the region, the Dubai Gold and Commodity Exchanges, DCCP. Andrew Ganef is the head of derivatives execution and clearing of risk in Europe for BNP Paribas. Jerome Kemp is an independent consultant who was previously a leading figure, a board member of the Futures Industry Association in the United States of America and around the world for many years, and also leading one of the leading general clearing members in the world for a number of years. Matthias Graulich comes to us from Eurex Clearing AG. He is the member of the executive board there of the largest central counterparty clearinghouse within the Eurozone. And last but by no means least, welcome to the Chief Derivatives Officer, someone who has been living the CCP adventure as Tadawul was launched in the course of the last year, Sri Kumar, the Chief Derivatives Officer of the Saudi Stock Exchange. So let me start by going to you, Sri. Perhaps you can give us a little sit rep and talk to us about, well, how you built your CCP and how you came to be launching the Tadawul CCP in the course of the last, good grief, it's only now, what, 4 months old? You're on mute, Sri.
Sorry, thank you, Patrick, and thank you for choosing me as the number one to answer this question. And it's exciting times in the kingdom. And this idea of establishing a central counterparty house was done in 2018, May 2018, and the actual going live was in August. So you're talking about 7 months ago when we launched our first derivatives contract, the MSCI Tadawul Index contract. So we believe that we worked very closely with the CMA and to launch this new central counterparty called Mukasa. And I represent the exchange. My colleagues, of course, I'm also talking on behalf of my colleagues in Mukasa. And it was definitely a strategy from our side that we needed to bring in a risk management house to manage the post-trade risk, which was prevalent in the market. And we thought a central counterparty, it is important that we launch a central counterparty risk center. And we have attracted attention here with the derivatives product. And we believe that we should be looking into going into the cash market, God willing, by the end of the year.
Fascinating, a very, very exciting time, obviously, to manage to put together such a huge undertaking as the central counterparty, first of all in the derivatives business and then moving towards the cash. Now, Andrew Dodsworth, clearly the Dubai Gold and Commodity Exchange is some way further down the line with your CCP, but perhaps you could give us a little bit of perspective of how you ended up in the Middle East and moreover how DGCX has grown over time.
Sure, thank you, Patrick. So both the exchange and the CCP were built in 2005 And so just last October, we celebrated our 15th anniversary. For us, the group has always had very strong Indian roots. And as such, when we sought to develop both the exchange and particularly the CCP, we took a number of elements from those domestic markets and incorporated them into our model. Most notably, the fact that we operate a pre-trade margin upfront model, which is different to many other exchanges, particularly those in Europe and North America. One challenge that we did face, particularly with regard to the CCP, was that at that time, because we were the first CCP in the region, was that there was in fact no existing regulations governing what a CCP should be doing, its obligations and the requirements, and that is understandable. So that challenge actually was an opportunity for both us and our regulator, the Securities and Commodities Authority, to work together to develop robust and effective regulations that sought to look at best practice from around the world and incorporate them into local requirements and regulations. And those regulations have worked well, not just for ourselves, but for other CCPs that are setting up in the region. So today, where are we now? Well, we have about 60 clearing members, of whom 15 are general clearing members. The membership itself is a broad constituency. We believe very much in having a broad approach to membership that ranges from banks and brokerage companies here in the region to firms based in the Far East as well as Europe. And again, we look at HFT and algo all the way through to point-and-click proprietary traders. Whilst we don't have any direct retail participation, obviously a number of our brokers do offer that service to their own retail investors. In terms of trading volumes, we're currently in the region of around $650 million worth of notional value each day, and we cover a wide range of products, all of which are available on the website, obviously. And just finally, coincidentally with the celebration of the 15th year anniversary last October, we also saw our first clearing member default, where the clearing member had open positions held on behalf of clients. And that test was a very useful experience, I think, for all involved. Happily, I'm pleased to report that it was able to be concluded with no impact to the wider market, and indeed no impact to the default fund that had been established. We were able to manage it within the resources that the defaulting clearing member had placed with the CCP. So in short term, that's our journey to date.
That's an incredible journey, and obviously a very emotional one. You've had, as you said, very strong original links back to India with your original ownership base. Just tell me very briefly, Andrew, then I'm going to turn the same question to Sri. How many clearing members do you have at the moment?
So we have 60 in total, of whom 15 are GCMs at the moment.
That's an incredible number altogether. And just give me a little bit of color. Where do they come from? Are they all based in Dubai or from around the region?
No, we've adopted a very much a sort of an open access model. We have clearing members that are based in Europe and in the UK, as well as in the region. So again, driven by regulatory requirements, but also by commercial opportunity and need. Where we see the chance to develop further, then we will look to open up the market in those regions.
Excellent, thank you very much. So Sri, I mean, you're obviously a much younger clearinghouse in the dynamic Saudi Arabian territory. How are you getting along in terms of reaching clearing members?
I think the start of the derivatives market, it was not mandatory for anyone to become a clearinghouse, and we had banks and brokers who became the clearing members. There were three categories. One was the general clearing members, and most of the banks became a general clearing members, and then those who clear themselves became the direct clearing members. And of course, those who clear with the rest of them were non-clearing members, basically brokers who who clear through the respective brokers. And we have great interest. In fact, more banks are signing up, and most of our brokers are signing up. And I think it's by the end of this year, from where we are, I think it's going to grow exponentially for the number of clearing members. I think it's exciting times. You're absolutely spot on by saying that we are a very young clearinghouse. We are now being recognized, and people do talk to us more, and we have more calls, more responses to become derivatives members as well as clearing members. So it is going to be a very exciting, and the growth is going to be exponential. Thank you.
Thank you very much, Sri. And that actually raises a very interesting question we've got from the audience. Thank you very much. We're going to come to that in just one moment. You're making the point, Sri, you're a very young market. We all know that it takes at least 12 to 18 months, if not 2 years, to see reasonable liquidity in a derivatives market. So we can't expect miracles overnight. But one question that came up, it's actually relating to, you mentioned you're going to be looking at using the CCP for the cash equities market in due course. The question is it interesting or necessary for a central counterparty clearinghouse to go to clearing in the cash market, especially if the derivatives market is small? Sri, maybe you might like to comment on that.
No, I think it is mandatory on our side, and it is important that we move on to that. That is our strategy, the exchange strategy and the clearinghouse strategy, to be a central counterparty for the cash market, and that's where we are going, and we are chugging along very well. We are working very closely with our brokers. There's testing is being done, and very soon we should be able to come out with some announcement when we can expect the cash market clearing, and I think it's important and it's critical because we wanted to introduce this post-trade risk management for the cash market as well. So it is key, and it is important to us.
Very interesting. And obviously, of course, central counterparty clearing in the equity market, something that's really only been with us for less than 20 years anyway. So it's quite a new thing, relatively speaking, in the CCP world. Now, look, talking about your developments, gentlemen, and hearing particularly the pre-risk margining model that you're using at DCCC, Andrew, and also the fact that you're discussing how after 15 years, you unfortunately had this situation with a member default, which you managed to deal with. I think that allows us to move along neatly towards Matthias Graulich. Well, you've clearly had a much longer life cycle, and as a corporate business, Eurex has grown over 30 several years from a project plan to being the largest CCP in the Eurozone. So perhaps we could look at something else here, the elephant in the room, as it were, OTC derivatives. Perhaps you can talk a little bit, Matthias, about how you managed to bring OTC derivatives into the prevailing exchange-traded derivatives mix.
Yeah, happy to do so. And perhaps let me start with elaborating a bit on the ETD side, which kind of was the kind of initial product on the CCP landscape. And if you look what is characteristic to ETD, so exchange-traded products, listed futures and options, they are highly standardized. They follow a very kind of strict protocol. And at the beginning, so when these products started to be executed on exchanges on anonymous order books, it was a kind of prerequisite, an enabler to have CCP clearing at the back end, because otherwise you would not be willing to be anonymously executed against anyone if you would have the uncertainty. You couldn't judge who is behind on the other side and what credit risk does that other person have. So the CCP as the kind of known counterparty was the key enabler. Now, looking at the discussion on the OTC derivatives side, so what were the driving factors to bring this discussion up was really the lesson learned from the Lehman crisis. And what we have seen in the aftermath of the Lehman crisis was that there was excessive risk taking, because to a large degree, risk didn't really have a price. I mean, there was no limited capital requirements, no collateralization in the bilateral world, and no kind of systematic approach to risk management to a very large degree. I mean, not I mean, there were of course exceptions. And then one looked at the positive development of the listed derivatives with a strong robustness during these kind of crisis situations. And one said, well, why don't we apply the principles from the listed derivatives clearing world to the OTC derivatives clearing, or to the OTC derivatives, and also bring them into central clearing to make sure that all the benefits we have are also available. So the key challenges for the OTC derivatives were at the beginning, you need to have a price to value and assess the risk of the product, right? So it requires some transparency on the pricing side to risk manage that product. We had to go to a higher level of standardization on the OTC side. So you had developments like the coupon standardization and other things which helped. You had to go onto a higher transparency on the execution side. So a lot of business moved onto electronic RFQ models where you have this higher level of transparency. When you have all these ingredients, you can assess the risk of that product, and you can ask all your members for collateralization, which I think is an important element to adhere to these kind of higher risk management standards and increasing systemic stability. And on the back end, you need to be able to liquidate those products. So if we have such an event where a clearing member defaults, you need to liquidate. So you need to have someone who is willing to put a price up for that product, which then requires some liquidity in that product. So and that's where the CCPs, but also the regulators said, okay, interest rate swaps are probably from a product spectrum big enough and liquid enough to bring them onto a CCP, but other products, say like swaptions, people didn't deem appropriately, kind of from a transparency, standardization, liquidity perspective, to bring them onto a CCP yet. So I think these are the key aspects. And at the end, what really the CCP brings are that the CCP, due to its multilateral netting capability, effectively takes out risk of the system, which I think is a very important element. The CCP manages the risk in a very systematic and transparent way. So the risk models are transparent. People know what margin and collateral requirements will look like. And the CCP clearly defines with its mutualization approach who is kind of stepping in if something goes wrong, and that is at the end the industry helps itself in a crisis situation when we would see a default. And the regulator has kind of translated that, and now looking at the excessive risk taking and the price to risk. So as part of and I think that is not to be ignored, that the capital rules for the banks were reviewed during that period of time. And now a regular counterparty would receive a risk weight of at least 20%. So there is a price attached to risk taking. And the CCP, because of its nature and the strong risk management standards, only has, for example, a 2% risk weight, also applicable to the OTC derivatives, which is, I think, at the end, a incentive mechanism, but also a signal of kind of attaching a price to risk taking to avoid what we have experienced in the crisis, which was the excessive risk taking.
Pricing risk, I think that's such a key pointer. I mean, one of the points you make out about the fact that risk effectively had no price in a certain way in the OTC universe. And that brings us, thank you very much, Matthias, on to Anton Ganev. I mean, looking at the risk agenda, as I think you like to term it, I mean, give us a little bit of a background to how BNP Paribas has evolved as a global clearing member, and we can understand just how large you and, say, a dozen other equivalent organizations around the globe are.
Thank you, Patrick, and thank you to the Arab Federation of Exchanges for organizing this wonderful event with such a diversified and complete agenda, and not to mention the impressive lineup of speakers. Very pleased to be among all of you today and honored to be invited as a speaker. Now, back to your excellent question, Patrick. And here, basically, I understand the topic and the agenda is much more broader in terms of scope, but since my expertise is on the clear derivatives, I'll be mainly focusing there. So to give you a bit of a background, BNP Paribas has been clearing for clients listed derivatives for more than 3 decades now, and OTC derivatives since 2011. And in fact, we have created the derivatives execution and clearing department, which I'm part of, in 2015 to consolidate client clearing for both listed and OTC derivatives businesses across institution and corporate clients. The idea is to offer a one-stop shop to clients where they can access, execute, and clear more than 50 plus markets through a single account, but also benefit from other value-added services such as single pool collateralizing, cross-margining across products, for instance, listed versus OTC cleared. And I'm sure Matthias know all about it, as we are launching this new service as we speak at Eurex, and hopefully we'll be the first GCM to do this for client clearing. But why I'm saying you all of this, it is to illustrate that as a GCM, our business is client driven, and it is, I would say, our absolute and first main focus would be and is on our clients, who will listen to closely and try to understand and identify their needs. This is how we approach new markets, venues, and products. So basically, and here, without targeting any particular market, just in general, our approach would be, if one of our clients is looking to open up to a new market, we'll be considering the opportunity of providing this or them access to this market through either an in last resort by sub-clearing this business, or if the economics are appealing, high volumes or interest from other clients, by becoming a member. Or of course, through one of our affiliates, if they are a member, which kind of bring us to my initial, previous point about the sub-clearing part. But basically, as any other business opportunity, this will be the first step in launching a new business, new market or product. It's the idea generation, which here it's basically filling the gap. So then, of course, we have the research, the planning, the costing, the competition, the risk reward analysis that we have just spoken about. So among all others, we'll be looking at market infrastructure, systems technology, existing players and competition. But to highlight, the main focuses would be the rules and regulations. Basically, are we allowed as a European entity governed by French law to operate under the local law of the given market, and so on? And mainly, and last but not least at all, the risk management practices. So, and since you rightly said so, Patrick, and it is my expertise, the risk management, I'll go step further there. Among all other elements, which all play an equally important part, market liquidity is crucial. And of course, we've already talked about this, and I heard another speaker talking about liquidity, which is also what is important to first of all create a CCP, but is kind of a chicken and an egg situation, because liquidity is needed to have a CCP. When the CCP comes into play, then it increases further liquidity and basically attracts more market players, and so on and so on. But basically, in terms of risk management and more technical aspect of it, what is important is the increased market breadth, or the size of volumes traded. That means that it increases trust coming from transparency, robustness, reliability in the dynamics of the market. But because it will attract more players, thus increasing further liquidity of the market, and more importantly, the depth of the market, which is the volume dispersion, or how the volumes are spread across different players, in order to allow for the market or for the different players to trade without affecting the prices. And basically, after the client interest and the competitive advantage that a new market could or would bring to a GCM, market liquidity completed by robust risk management are, for me, key to attract a new GCM.
I'm meeting myself. I'm terribly sorry. So just a quick follow-up on that, which is, it's interesting you say a lot of your demand to go to a new market will tend to be client-driven.
That's true. It's actually, I would say, today it's all about client interest, and if they're interested into a new market. And again, to come back to the market liquidity, if there is no market liquidity, they would not be interested, right? So it's all back to it. But yes, it is completely client-driven business. In terms of, I'm speaking here about the client clearing, right?
The client clearing business,
yes.
Absolutely. No, but I think it's important to understand, because I think some people think sometimes that there are people in GCMs who are speculatively excited about just joining new central counterparties. And it's quite difficult because you have so many restraints on your capital and on your time in this world. And that, I suppose, segues beautifully. Thank you very much, Anton, for your insights. Moving from that risk part of the piece, the client-driven piece, to someone who's been a titan of the GCM industry for decades, Jerome Kemp. He's recently stood down. I must say, Jerome, I'm thinking that these books that are lining your shelves behind you are probably many of the thousands of pages of documentation you've been through in your clearing career. But if we look at that career and look at what you've achieved, one thing that is very exciting is looking how mature a business like Mukasa can be as it launches today. It's very much driven by what we've learned in the clearing business over the course of major events and pitfalls in recent decades.
No, it's a very interesting way to sort of open this part of the conversation, Patrick. And before responding or commenting, I'd just like to thank the Arab Federation of Exchanges for the opportunity to speak today. You know, Patrick, as you say, I did step down after about 35 years in the industry. That being said, I'm very, very busy. I've just sort of given another sort of stripe to the way I approach my involvement today. When I first started in what was then the futures industry, there was a broadly accepted view that there was no risk relative to futures trading because everything was margined. And behind that simple assumption, there was essentially, you know, the blind acceptance. Yes, you would be called on your margin and you would pay, and everyone would be whole, and we would move on. Obviously, over the past 30 years, we've seen significant events occur on markets. Over the last 10 years alone, I can count very easily 4 or 5 major events where we saw extreme market volatility, which gave rise to the inclusion of OTC derivatives that Matthias was talking about, in requirement to be centrally cleared by a CCP. Indeed, a increase in the overall capital requirements, the amount of capital that bank participating FCMs are obliged to hold to support their activity. And I think that this is all very good, because at the end of the day, and I think these were points that were made by both Sri and by Andrew, risk management is really at the core of what a CCP does, whether you're talking about exchange traded derivatives, futures, or OTC swaps. The CCP serves to step in and intermediate the various exposures and payment cycles between buyers and sellers. And I would argue very strongly, and without too much effort, that we are much safer from a market perspective today than we were even 10 years ago prior to the GFC. What fascinates me the most, and quite clear, is that today we exist in a market where we can execute a trade in microseconds or even nanoseconds, but we can take generally 48 hours to settle a trade, and even much longer depending on what the underlying instrument is. And for me, I think that that is going to very much represent the next wave of focus in terms of post-trade risk management from a CCP perspective. I found it exceptionally interesting to hear Shri mention that cash equities were, being considered or are already, part of or included in that scope of activities that the CCP, the Dawood covers in Saudi Arabia. I think the events of the past few days, we saw a major default occur in the equity space, which caused billions of dollars of losses to some very major names. I think just gives more of an argument for considering how we can actually impose or expand the CCP's role into the most simple of underlying, such as cash equities, because settlement is really at the core here. When you think about the risk assumed by FCMs today, they essentially forward money to CCPs and then expect payment from their various clients over the course of the day. This is for obviously CCPs that don't pre-margin, such as Andrew's exchange, and that leaves that very significant exposure there. So an FCM will live with 24 hours at least of exposure on some very big numbers. What I think is very exciting is that today there is an opportunity in the cleared space to take advantage of some new and very sophisticated technologies that allow both CCPs and their members to collapse settlement times significantly. And I think, particularly for the members of the Arab Federation of Exchanges, I think they are coming into this industry at an incredibly powerful vantage point, because as opposed to sort of having to go the journey of antiquated technology, which imposed very long settlement cycles, they can immediately adopt some of these new technologies, many of which are based on distributed ledger technology, to help collapse these time intervals and just bring additional safety and control to the overall industry. So I think that over my career, I've gone summing up, I've come from an area or a space where there was no risk to there's where considerable risk, and finally I think that the industry, thanks to developments in technology, is coming to full circle in terms of on the one hand affirming the centrality of a CCP role, but also via the adoption of these technologies, which make these markets much safer for everyone.
I think you make some excellent points there, Jerome, and indeed it's interesting looking back on my own several decade career in derivatives, just how looking back we appear to have been gung-ho. I mean, I remember actually writing this book, Capital Market Revolution, and when it was published in 1999 about what fintech, as we now call it, was going to do for markets, I discussed the idea of why wasn't there central counterparty clearing for equity. And it was interesting because the equity markets laughed at it, and most of the professionals in central counterparty clearing were all scratching their chins and going, that's an interesting point, we really have to think about it. And yet now it's becoming increasingly ubiquitous. And that's just one area of the many points in the cycle that you make, which is quite fascinating. And indeed, I mean, that possibly allows us to shift from Jerome to Matthias once again, because I think, Eurex has been a leader in providing your own proprietary central counterparty clearing over the course of 30 years, which is an outrageous shift from the IBM X400 box to goodness knows how many programming languages and who knows how many different iterations of software. How do you keep up with, the changes in process in CCP have been quite significant, as you've mentioned. How do you also manage to manage the whole process of the technology process and the whole business? You're muted, Matthias. Sorry. And you're so lively.
Thank you.
Looking forward to this answer. You're so excited.
Thank you. No, thank you for your question, and that's an interesting one. And Jerome alluded to it. I mean, he mentioned the distributed ledger technology, and the interesting thing is that when this whole theme, distributed ledger technology, blockchain, came up a couple of years ago, I read a few articles about, will distributed ledger technology replace CCPs? And reading that article for the first time, I started thinking about it and said, is that really a threat for us as for our business model? But I quickly came to the conclusion, no, it's not, because a CCP, as it was said, does risk management. Distributed ledger technology is a kind of not doing risk management, but it can be extremely useful for CCPs in increasing process efficiency. And I think Jerome mentioned it, we today have 48 hours payment cycles. We have settlement cycles for securities of 2 days. So in the world of blockchain and the DLT, there is no need to have 2 days, and it's just a legacy, and the whole infrastructure works on 2 days. So changing that is not an easy task, but I think that is where DLT can really play a role. And there are some interesting fintechs out there who are pushing ahead on these kind of topics to make settlement more real time rather than a couple of days, which of course will also help the CCP cycle, because at the end we can do real-time risk management on the CCP side and say, oh, we know in every second what the margin requirement for that person would look like or for that institution would look like. But if it takes a couple of hours for the clearing member to send that money to the CCP, and what Jerome mentioned, for the clearing member to collect that money from the end client takes even longer, then of course this kind of real-time risk management of the CCP, kind of the value is limited as it takes so long to collect the money from the client. So for me, these technology elements are really kind of areas where we can improve efficiency, which we can use as enablers to make CCP clearing even better than it is today. And I wouldn't see that as a threat or replacement at all, with one exception. You mentioned cash equities, and now the risk management element on the cash equity side is really referring to this 2-day settlement cycle, right? So you enter into a trade and you don't know whether you get the money or the security 2 days later. So the CCP intermediates it and guarantees that you get it. Now, if we were in a world where cash equities would be settled instantly, you wouldn't have that 2-day risk, and therefore the CCP clearing service would not be needed anymore. And these are, I mean, there are also other considerations you have to take into account when talking about moving from 2-day settlement to instant settlement. But that is an area where I could see that the risk could be immediately taken out of the system if you would move to a shorter settlement cycle. On the other hand, you would create new risks on the cash equity side if you would take that move. But that is how we look at technology. So we look at these technology developments as enablers. We have a number of use cases ongoing and on the DLT side. But I think we are not yet at a stage where we would apply DLT on the CCP side on a very broad base. So I think it's still kind of in the development and kind of testing phase.
Very interesting altogether. And of course, you mentioned that the whole issue of time and the relationship of time per se. I mean, Jerome, looking at it from your now retired vantage point as having been the boss of one of the biggest GCMs in the world, is there something missing right at the moment that you really think that, or perhaps something that you think imminently needs to be improved, particularly in the light of what we've seen this week with a considerable portfolio of equities having to be dumped on the market because of fund insolvency?
Again, Patrick, I would come back to the points that have been raised by many people around, the embracing of technologies that help to, essentially collapse settlement cycles. And I think this broadly applies whether you're talking about a clear derivative, a cash equity, FX operations as well. Any trading activity that implies, a payment cycle obviously carries with it a certain amount of risk. So I think, many participants always wait until the crisis has occurred to step up and, try to find a solution, sort of a magic bullet. Quite frankly, in my career, I found that there are no magic bullets, and this is a question of process. But I do think, as I said before, that this is a moment where both CCPs and their members can show significant leadership in embracing these new technologies and moving forward to create these safer markets that we're all very focused on. And I think this will happen, whether it's voluntarily or by regulatory edict, one way or the other. I think that this evolution will occur.
So the evolution is ongoing. Anton, looking at it from your perspective, and you're obviously a very risk-centric individual and a very risk-centric organization. What do you think is the concern in relation to the developing world of the CCP business?
Well, thank you, Patrick, again for this excellent question. And here to echo what Matthias and Jerome has just said, cleared business is definitely much safer than bilateral one. So here I would like to highlight 2 points. Well, the first one, and what I've observed through my experience as well as the different events that I've studied so far, the clients who defaulted on their clearing agreements, excluding, of course, frauds and major potential operational incidents, in most cases due to unpaid margin calls, have struggled with liquidity issues, which were generated by their OTC positions with another counterparty or prime broker, where the prime broker or the other counterparty on the OTC positions have marked the market in an unexpected way, significantly against their positions, which results in valuation, margin disputes, and so on. If of course there are disputes, but in general, and we've seen it very recently, as we speak, there is this big hedge fund who was who defaulted because of margin calls. So what does the clearing brings to the table is this higher transparency and homogeneity in valuations and margins, even though there are some differences in the margin methodologies across CCPs, they tend to be quite similar in most of the cases. And here I'm highlighting margins because in the bilateral world, they may not be even margins, right? Yeah, well, today we know that the new regulations, it is coming more and more the how to say the rule and the exception with the SIM methodology for bilateral margining and so on. But still, it's not that generalized. But that leads me to my second point, which I believe it's very important. And don't get me wrong, margins are good. They're a significant risk mitigant and are very important. However, they may be also constraining, as they usually tend to be pro-cyclical. They tend to be very high during stress markets and very low when markets are calm. And this creates quite of an issue for the following reasons. It adds further liquidity pressure on clients who are already in a distressed situation and are lacking liquidity, so it kind of enhances the difficulties they already have. But in the same time, during low volatility markets and call markets, it increases the GCM's clean risk. What I mean by the clean risk, this is the stress loss over margins, and this is the clean risk over the clients, but also what the CCP has a risk against the clearers, because the stress loss over the margins will also increase, thus resulting in a higher default fund contribution for the members, which is more uncollateralized exposure. So basically,
It's one of those problems where we're actually running into not T+2 settlement, but T+60 seconds settlement. So I'm terribly sorry to interrupt you there. What we've seen today, though, is the issue of risk. Risk had no price in the OTC market, as Matthias Grolick originally said. Jerome Kemp explaining to us the situation over the course of the last 30 years and how originally we didn't think there was a risk because there was simply margin, which, as Andrew Dodsworth has pointed out, they even pre-margin the margin by effectively demanding that it's in people's accounts before they allow them to trade in order to make DCCC more effective. And at the same time also then we've had Anton's multiple comments on the whole risk stream, because ultimately what we're looking at, ladies and gentlemen, is a 177,000 second problem in terms of settlement, which is T+2 settlement, which provides us with all sorts of risks, and even a blockchain is 540 seconds. But the most important thing, ladies and gentlemen, while I wish to say thanks to my panel, is to share the words of Sri Kumar. He shares the optimism of Mukasa, the newest central counterparty clearing, not just house in the Arab Federation of Exchanges, but indeed throughout the world. Ladies and gentlemen, my thanks to the panel, my thanks to Sally Yassing from the Arab Federation of Exchanges and the AFE for inviting us all here today, and indeed also huge thanks to Stephen, who's been indefatigable in the background, making sure this panel went successfully. Gentlemen, thank you very much for your time. I hope you enjoy the rest of the conference.